Good morning, everybody, and welcome to another edition of Fast Market. It's Monday, July 23rd. I'm Kevin Hinks. I am joined on set today by co-host of Fast Market, Tom White, and the CEO of Prosper Trading Academy, Scott Bauer. Good morning, Mr. Bauer.
Good morning.
See you. Thanks for showing up on a Monday.
Always pleasure to be here.
I don't like guys being more tan than me. That's an old rule from the grain floor. Never trade with someone who's more tan than you.
That's everybody.
That's always.
You have to put on a little extra sunscreen.
Hey, that's right. Here's my question, and let's deal with the elephant in the room, Tom. Does it impede your trading to have so much hair on your head right now?
Sometimes. You never know.
I got him.
I like that.
All right, let's get to the market because we got a lot to talk about. How about this? I'll show you some numbers. 887 companies putting out earnings this week. A third, 180 names in the S&P 500, 33 names in the NASDAQ, and 11 Dow stocks. So, I'm fluent in hyperbole, but this is a lot of names. This is a big week for earnings this week.
Yep.
We got a lot of names and a lot of big names, right? FANG stocks, Netflix started off not so good for a start of FANGs, but now we've got Facebook, Amazon, more big names coming up this week.
Right.
Guys, let's start this conversation with the tweets that have happened so far this morning. They're affecting Amazon stock. Amazon down about 10 and a half bucks. It was down 17 bucks.
Down nearly 30 bucks at one point.
Right, exactly.
Over 25,
and that's because President of the United States, Donald Trump, has been tweeting this morning about Amazon and his dissatisfaction with the Washington Post.
Right.
Ryan, let's throw those up on the screen so everyone can see the tweets. And that is what's affecting. This is not a political show, so we're not going to do anything having to do political. Everything we do here is something you have to or can trade off of. And this is what Donald Trump put out this morning, the Washington Post. You can read it on the screen. I'm not going to read it for you, but you can see he is tweeting about the Washington Post and its relationship with Jeff Bezos, and that is affecting Amazon stock. Guys, here's the question. How do we, when you see a tweet like this and its effect on an underlying, what do? Do you be patient and buy a dip? Or do you be careful here? Amazon, you're right, was down about 30 bucks. I saw it down 17 right after. Now it's down about less than $11.
Right. I mean, that's the whole thing. It's headline risk.
Risk.
And what do you trade on it? Well, it depends on your outlook for the corporation as a whole in general, and whether you can stomach the volatility that's caused by this headline news. And I think that's the way you have to look at it. I'm sure there was a bunch of people out there that took advantage of this dip.
Right.
Maybe sold some put spreads, maybe bought some call spreads. But at the same time, if there's more concern for more headline risk, then you've got to be careful on any bounce back.
Scott Bauer, ebb and flow.
Yeah, you look at all of the tweets coming out over the past 3-6 months on tariff talk especially, and then some specific companies. And I think Goldman Sachs actually put out a report on this, that if you go back and if you had bought in every time a stock sold off, and I'm not advocating doing this, it's looked good.
Buying dips. Buying dips has worked so far in this market.
It has.
And using two things you can do as a trader, right? You can use headline risk like this to enter, or if you have bearish hedges on, you can use headline risk like this to exit bearish trades and buy the dip.
Right.
One way or the other, you can use this, right? But staying fundamentally sound, using vertical spreads, using theta, using high probability. But I think what news stories like this allow you to do is to use the ebb and flow of the market for better pricing.
Yeah, that's a way. You can set, set limit orders on things that maybe you want to buy a little bit cheaper based on the fact that we might see some tweets that it's going to cause the market to go down, or an individual name. So you have to be prudent with that stuff. My only caveat is stay risk defined if you're going to start playing this headline risk in a lot of these stocks that are out there. But the market today, Kevin and Scott, it's basically the calm before the storm, in my opinion. I think you're waiting for all these big reports, starting with Google Alphabet after the close today.
Right.
And that's what it is. It's the calm before the storm, because
we're going to get to Google in a minute, so just hold on.
Yeah.
But before we do that, let's talk about a couple things. Now, guys, we have data. It's a slow start to the week in terms of data, but we have data coming up Thursday and Friday, and I'm going to paint you a scenario. The expectations for durable goods on Thursday, because of airlines and what they do, is a big number. It's got a 3 handle on it. right? The expectations for GDP on Friday got a 4 handle on it. What do we do? How do we take a look at knowing that there's a big event coming up on the horizon? Not only do we have earnings season, but we have these 2 big data releases at the end of the week. Scott, we'll let you go first this time.
I think you look at these numbers, and I've always said this, they're both of these numbers are big numbers. They're
top 6, right?
Yep, but they're only one piece of the puzzle individually. To me, I don't want to try and get ahead of the number. I'm not smart enough to know what the market is going to do.
Spoken like a true market maker.
There you go. But what I have learned and what I have experienced is these numbers come out, and if you have the ability to be in the market and watch that first move and kind of fade that first move, typically you do pretty well.
For everyone listening, that kind of attitude towards the market is the arrogance that gets pounded out of you over years of trading options. Pounded. Tom White, tell us about what you're thinking about these 2 data points coming out later in the week.
I think my concern going into these numbers is expectations are built in. They're so high at this point, right? We've got the NASDAQ just off all-time highs. We've got the Russell 2000 that's still relatively stable. Dow Industrials made some gains last week. I'm concerned that the expectations are too high for some of these numbers. And
4 handle on GDP. Hello.
And that's going to be a concern moving forward. Yeah. Or if they are as hot as expected, then you have inflation talk creeping in. We're seeing bond yields starting to rise over the last few sessions. We're hitting at monthly highs on that 10-year yield.
2.94 in the 10-year, very quietly.
It's a month high too. So we're starting to see that creep back up in some of those different areas of the market. And there's some concern going into these. Because you can play it both ways. Is the market expecting too much, or are these numbers going to be so hot where you get inflation rate right?
You make a great point, because many times the news comes out and it's not good news, but the market takes it that it is good news. So if the numbers are not as good, not as hot as what is expected, the market may look at it and say, well, you know what? Inflation maybe isn't as bad. Maybe rates are not going to go up as quickly. So that's why I said earlier, it's hard to get ahead of that number, because you really don't know how the market is going to interpret it.
So here's the thing. With a 4.2 expectations for GDP, what if it comes out 3.9? Is that disappointing?
No, because
not at all.
Because not at all. Point.
Because the market, that's what I said, the market might be expecting a little bit more, but the expectations set by the economic team in this administration is like 3 to 3.5. Exactly. So it's still beating those expectations.
And you got to be careful when that number comes out. Ooh, that's a disappointing number, 3.9. Yeah. Wait, is it? Hold on a minute.
No, it's not. And
exactly.
And if you look over, this is a first read on this number. So we'll get 2 more reads for the Q2, but this is the big one to set expectations moving forward.
And the same idea with durable goods on Thursday. The number looks like 3.2%. It looks like a big number, but ex-transportation, it's only up 0.5. Yeah. Still not a bad number though, ex-transportation. That's still solid.
Yeah, we had decent durable goods last year too, or last month too. So I think this ramp up that we saw in May and June is going to start flowing through into a lot of this economic data, except for housing, which came out today.
The week in earnings, Scott Bauer. What is the focus for you at Prosper Trading Academy this week in earnings? A lot of names. Obviously, you don't want to trade 887. You want to pick out, stay in your lane here. But which ones are you looking at?
Obviously, you have to look at the FANG stocks.
Right.
That goes without saying. I like Triple M. Looking at Triple M.
We're going to cover that later on in this show.
Yes, we will. And the big thing for me looking forward is, do the FANG stocks all trade in concert with one another depending on what each individual earnings are?
Do they trade like an index?
Exactly. Or if Google reports way off the spectrum one way or the other, do the others follow, or is it stock independent?
I think they will follow.
Google has a history of big moves on earnings, much bigger than the market maker move.
And a lot of the analysts are coming out ahead of this report giving probably mixed reviews in the near term, but longer term into the end of 2018, the expectations are still there for this company to become the first $1 trillion market cap company. Right. And I think you're going to have to look at the ways that they controlled costs going into it, and also how some of their Waymo and some of their other segments are working to provide that growth moving forward into the latter stages.
All right, the last thing we want to look at here before we get going into some of our stories is crude oil. We have a crude oil trade on. We have a short put vertical on in paper money, in our paper money position.
Yep.
But I want you to look at the working orders that we have in crude oil. I want both of you guys to comment on this because we have the short 65-63 put vertical on.
Yep, in the
right?
September.
That we sold at 51 cents
futures, right.
a few days ago, and now it's trading about 28 cents.
Yep.
So if you look, because of the scale, and we were thinking that we have a 60-cent offer, but for the exact same spread, we also have a 15-cent bid.
Right.
So if you look at our screen right now, we're 15-cent bid
Yep.
at 60 cents. It's almost like we're making a market. But that's what I want you to talk to you guys about. Is that something that our viewers should be paying attention to when you're putting in orders? Like 15 cents. If we fill this spread at 15 cents and if crude oil stays higher, eventually we will. There's some time involved. There's still 24 days on this trade. But that's about 70% of profits. Is that the way our viewers should be looking at this and putting in resting orders at your numbers?
You should. I think you should, Kevin. But you have to look at your risk tolerance on something like this. So typically on this, if I sold that vertical for 51 cents like we did in that example trade last week, maybe if that thing improved by 40 or 50% of...
Here's the point.
And that's what I would probably do. Maybe I'd raise my bid on that just because volatility in oil, I know it's a risk-defined trade,
right.
but volatility in oil, the way we've been swinging back and forth,
right.
maybe it's a good idea to maybe raise that bid a little bit.
Because let's face it, in paper money, Scott, we have $230 on the table here.
That's right.
On a one-lot spread, right?
Which is huge.
Right.
I at this point, I don't know that I would raise my bid, though. That's
right.
That's great risk management. What I would probably do, though, is put in some sort of stop if we start to see it go against us. So I know I'm going to lock in at least some of my profits, but still let the market, come our way a little bit now, but get that risk protection in there. So if it does start to move against you, you're locking it in. You're going to be out. You're going to lock in some profits, and you move on.
Right, exactly. So remember, you've heard me say it all the time on this show. We are not in the storage business. We are in the moving business.
That's right.
So keep this moving. If you think that crude oil has sold off here and it looks strong, there's no reason in the world you can't adjust this and cover because we have it in for 70% profit. Right. But you have 24 days to go, and you've made a good chunk of profits in just a few days.
Right.
There's nothing wrong with taking those quick profits now and saying, well, I'll just keep my powder dry, wait for another move, and see and let this market make the first move,
good trade
locking
management
in
skills.
profits.
Yeah,
absolutely.
Good trade management skills.
And I think that's what people have to understand is there's always going to be another trade to make.
Yes.
So when you say keep your powder dry, whether it's later today or tomorrow, promise you there will always be another trade to make.
All right, guys, let's start to our big topic of the day, and that is Google. All right? I know. I'm going to make a statement here. If Alphabet, the name of the company, would like us to call their company Alphabet, please change your letters because you can't call yourself Google Alphabet and spell it Google.
Right.
All right? There's my first little rant that I'm going to do today.
It's like us living in Chicago. It's like Sears Tower.
Yeah.
It's still the
Trace
Sears Tower to you
come
and
on.
I and Kevin.
Yeah, come
not
on.
Willis Tower.
Anyway, all right, there's our rant for the day. But Google. Now, here's what I'm going to say about Google first and foremost. It tends to make bigger moves than the market maker move frequently. And now we're looking for a $47 move right now, but I've seen this underlying move $100 when the expected move was 30.
Yep.
So what should our viewers be careful for when looking at this number?
Well,
Scott, go first.
I'll go. First off, I think you don't want to do anything naked.
Right, of course.
Meaning, certainly don't sell any downside puts without having protection on a spread. What I actually like in Google is the potential of putting on something like an iron condor, where yes, the move is typically bigger than like what you said, Kevin, the market maker move. But you know what? You see big snap moves right out of the gate, and then you come into the next day or two trading, and you may see it come back into line.
Because you do have 4 days.
You have 4 days on this one.
Like you said Friday on the show, this is a trade that once these earnings come out after the bell today, you still got 4 days of trading, Tom White.
Yeah, and that's what one of the things you have to realize when you're trading the July 27th weekly. If you want to trade something short term, you have 4 days to expiration. You can go out to other weekly cycles, even to that August cycle, make trades based on where you think it's going to be in the next few weeks. But at the same time, if you're going to do something short term, like Scott said, stay risk defined going into this. And you know what? There's people on this name, because it's just below all-time highs, that people that are bullish and think that it's going to keep going. There's people on the valuation side that say it's overvalued at this point, and if they miss on any metric, we're going to send it down.
Look at that. Even we put up a 3-year weekly. This stock is trading just a few dollars. Now it's $9, but a $9 doesn't seem like a lot when it's $1,200.
Yeah, that's
and
pretty
that's
tiny.
that's what you have to look at. $47 anticipated move that the option market's pricing in at this point, and that can move into the results today because implied volatility is relatively high.
$47 though in a $1,200 stock, that's a rounding error.
Yeah.
That can happen quickly.
Yeah, it can happen quickly, and it has. You made a good point. It has in previous.
It's got a
earnings
history
reports. Yep,
of moving bigger than that,
downside and
especially
upside.
what Scott said right at the open, right? The initial move, which is often exaggerated, right? Because think about what it is. It's after the close, right? It's pre or post market, so it's less liquid. So you always see, sometimes you see many times an exaggerated move when earnings come out, and then it settles much closer to a normal range. But that's what we have to prepare for, right? Everything we do here is in preparation for exactly what we're going to get and what we digest. So we have to understand that, we've got a 3-day trade. No, by the time this comes out, it'll be a 4-day trade still. So how do we want to attack this?
Well, I think we should look at a couple different examples because
absolutely.
Wait, Scott made a good point.
You can do
there's a bunch of different trades that we can do. We could probably put on an example one at the end, but let's discuss.
But any trade that we do, Tom,
Right.
will have much more room than that market maker move is saying. Because knowing the history of Google, you have to be prepared for something bigger than that number.
Yeah, I like going out about 5 to 6% instead of the close to 4% move that is expected here, and maybe even a little bit further. Obviously, if you're in the selling mode, whether it's an iron condor, put spread, whatever it is, you're not going to capture as much premium the further you go out because your risk is quite a bit less. But you're right, Kevin. I like going a little further out. And I love the iron condor strategy, and I know I keep harping on that, but you get a stock like this, and there's so much sentiment, like you said, Tom, that comes out. You have the people that think it's going to go at all-time new highs. You have people coming in looking at the valuation, and I think there's just such a tug of war, such a push and pull here that I love playing where you can win on both sides of the market.
All right, Scott Bauer.
Now, Scott makes a good point because you can increase your probabilities if you go outside that scale of that anticipated one standard deviation move, which is roughly about $48 or $47 right now.
Then you guys now, with the stock trading about $1,195, give me the short strikes that you're thinking of in terms of Google. Are we going down to 1120? Is that far enough, or is that too far?
That's probably a little too far for my liking in terms of the type of credit that I would receive.
Yeah, you want exactly, because remember, the further you go out, the trade-off is, and we're going to use the trade-off word a lot on this show, you get less premium, higher percentage of probability of finishing out of the money, but you don't get paid as much. We want you always to get paid for the risk that you're putting on. We get questions at shows all the time. Well, if you're doing 70, 75%, why not just do 95%? Well, the answer is because you don't get paid.
People do that,
because you don't get paid for the risk you're putting on. Because anytime you put on a trade, you're going to have risk in this market. Make sure you're getting paid enough for that.
Reward to risk.
Exactly. So, all right, so what are we looking for?
I kind of like
mark them out, I'll fill them in.
I kind of like the dollar credit on both sides. So I think that puts us around maybe the 1135, 1130 to the downside.
All right,
1135,
$11.30. 1130. There's about 80 cents.
Okay, and now look to the upside, about the same distance. So we're probably looking around what, the 1250-ish area?
Actually, probably a little bit more,
1250, 1255.
Yeah, it could be a little bit more. Yeah, Tom, I think you're right. Maybe 1255.
We can tweak it. There's about 190. So that was about $1.10. So we throw these on the Analyze tab. Let's take a look. Let's see. Let's clear our trades out here.
Yeah, we might have something in there. But that, Scott makes a good point, and Kevin does too. It's $5 wide. You're collecting roughly about $1.90, $1.95. So your risk is just over $3 on this. But you do
That's pretty equidistant right there, guys. 30, not even a 1 delta spread here.
Yeah, and I'm going to go ahead and reset those slices.
Yep, I already did.
Oh, you did? Okay, Kev. Sorry about that.
Oh, it's just habit.
Let me redo it, So there's your break-even points, basically 1252 on the upside and about 1133 on the downside. It's basically your break-even. So you'd have a nice wide range. It's risk-defined in nature. You got to be comfortable with the amount of risk that you have on versus the credit you collect. But implied volatility will collapse tomorrow morning post earnings.
And you can see about an 88 percentile probability of the stock finishing in between those short strikes.
Yeah.
Right.
So even if you do have that outsized move, Scott made a good point. If this thing goes down $100 after earnings tonight, it could easily rebound, and we typically, or don't typically, but historically we have seen moves like this, where the stock will sell off $100 and then the analysts will come out and say, oh, we like it at these valuations, it's oversold, or it explodes to the upside and then maybe sells off a little bit as people take profit. So there is that chance. You got 4 days until expiration after post earnings for this to normalize in between those two short verticals on this particular type of
And
trade.
Scott, chance to make $195, $305 at risk. Not too bad. It's about two-thirds to one. That's not bad.
Yeah. No, not bad at all. Personally, I'd like to see maybe a bit more, so maybe I'd have to tweak my strikes on the put side, maybe come up a little bit, because I'd love to get 2 or 205.
We can do that right here in real
probably
time.
if we tweak those strikes,
How about 1140, 1145, something like that?
even the 40-35, right? Or was that what you had?
40-35.
40-35, I'm thinking.
Yeah.
I bet that puts us to about 205 or so.
There it is, $2 right on the nose.
Yeah.
There you go. Real time we're changing these trades, everybody.
Yeah,
So-
there's a good example trade,
Right.
and then we can take a look at this over the next couple of days to manage it out of until completion.
Look at basically no delta change
Yeah,
by trading that
And this is what you liked a lot too here, Kevin, the
Yep.
positive time decay. Theta, $25, $24 a day on this particular trade. And that fall in implied volatility will really help this trade as it's a short Vega position, this short iron condor.
All right, I'm sending this in at $2 credit, and I'm sending that away.
All right. That's a good
All
one.
right.
That's a good one to manage.
We
out
are
with
off to a
clients.
great start on this show. That's a good conversation, guys. All right, coming up next, we're going to face off with Ben Watson live from Salt Lake City, Utah. We're going to talk about Lockheed and United Technologies. They have earnings as well coming up. Stay right here on the TD Ameritrade Network Fast Market. We'll be right back.